We are all set to bring to you our next panel discussion on affordable low-income housing, developing a sustainable supply ecosystem, fostering a conducive environment in India's distributed mortgage finance market, healthy competition between banks, HFCs and NBFCs. I'd like to invite on stage our panel chair, Mr. Shriram Kalyanaraman, Managing Director and CEO, National Housing Bank. Let's put our hands together for him as he steps onto the stage yet again. As a part of our panel discussion, joining us as a panelist are Mr. Anil Sachidanand, Managing Director and CEO, Aspire Home Finance. Let's put our hands together for him. Also joining us, Mr. Shankar Tripathi, Chief Executive Officer, Aadhar Housing Finance. Ms. Shruti Gonsalves, Chief Executive Officer, SEWA Grih, on stage, please. Thank you, ma'am. We also have with us Mr. Sandeep Menon, Managing Director and CEO, Vastu Housing Finance Corporation. Mr. Vivek Gupta, President and Head, Shriram General Insurance. We'd also like to extend a warm welcome to Mr. Milan Govardhan, Executive Director, Kush Housing Finance. And I'd like to request all of you to please bear with us a couple of minutes till our panelists settle down. We'll have about 40 minutes of discussion time and about 10 minutes of questions. Once again, a reminder to all our guests to please put their questions up online with our hashtag ET Housing Finance. And may I remind all our guests to please share their feedback with us. All of you have your feedback forms on your tables and you can let them be there or drop them off at the registration desk on your way out. I'd like to request our guests to please settle down. Sir, all yours. A request to all our guests in the hall to please take a seat. We're about to begin with our final panel discussion of the evening. May I request our guests at the back end of the hall, please? We're aware that this is the final panel discussion and we can promise you it's going to be a very interesting one indeed. So may I once again request our guests at the back end. Gentlemen, may I request you to please take a seat? Sir, all yours.
No, I don't. Hello. Yes.
Sorry, is this on?
Yeah, it's on.
Yeah. Yeah.
It's on.
Thank you. We would start by introducing all my panelists. You can start by introducing yourself.
Good evening. My name is Anil Sachidanand and I run Aspire Home Finance, a small ticket home finance company. We started 2 years back.
Good evening. I'm Sandeep Menon. I run Vastu Housing Finance Corporation. We are a startup housing finance company.
Hi, good evening. My name is Milan Govardhan. I'm part of Kush Housing Finance Private Limited team. We received license last year, October, and we started operations from February.
Good evening, I am Tripathi. I am Chief Executive Officer, Aadhar Housing Finance Company. Average ticket size of the Aadhar housing is around 7 lakh rupees.
Good evening, everyone. I am Shruti Gonsalves, CEO of SEWA Grih. It's a low-income housing finance company. We started our operations last year.
Good evening, everyone. I am Vivek Gupta, representing Shriram General Insurance. And we started SGI about 8 years back.
Good evening. I'm Sriram and I work for NHB. Essentially, a couple of questions I'm going to place with the panelists. Let's get their answers and then the house will be open for questions. So we would start with the lady on the panel. Being really a very small, which is catering, the company caters to the really what I call the lowest income segment, which is with the average ticket size of probably 2 lakhs to 2.5 lakhs. So one, what made you look at that segment much before all this came in? That's one. And two, what are the challenges you faced?
Sure. Thank you. As the name suggests, the genesis of my company lies in SEWA network, the Self-Employed Women's Association. And it's a very well-respected, one of the well-respected social mobilization network, which all of you are probably very well aware of. The idea of having a separate housing finance company came up with the fact that many of our women members who are not typically only in Gujarat and who are all across India, we are working currently in 14 states, that is SEWA. Those people, apart from having access to microcredit or microfinance through various means of thrift and credit cooperative societies or SEWA bank, also had a huge demand for home improvement or incremental upgrade. Now I am talking about a profile of customer who is typically engaged in informal sector trades, and so goes for her household. So whether her spouse or a partner or any of her adult child, whether a male or a female child, they are all engaged mostly in informal sector trades. So that is one sector. The other part of the story is that typically they stay in a area which is not considered to be a mortgageable title area. And that is where the whole story of my company begins. We look at the segment from informal sector trade and informal tenure, land tenure as well. So when I am talking about informal land tenure, it is not that we are promoting encroachment and irregular colonies, but we are typically financing people who have been either shifted from the Juggi Jopri clusters or slums to a relocation areas, or they have been given a possession slip or a license to stay by a relevant government authority, and they have been staying or occupying on that piece of land for last 20-25 years or probably more than that. So that is the genesis of the company, and what made us look at is that there is a huge demand, there is a huge untapped grey market, whether most of the affordable housing finance companies would also want to look at it, and they would be very, very keen if the land tenure piece is clearly sorted out and we get a clarity on it. Land being a state issue and it's typically handled by state in its own way. So that is where the whole complication on the complexities of the issue lies. So that is the one challenge. The other challenge that we faced is to mobilize sufficient amount of capital so as to be able to finance these people, this set of individuals. So that is where I would like to end my comments on.
Okay. Milan, from Kush side, probably you are the newest kid on the block,
Right.
especially handling the low ticket sizes.
Right.
What's your view?
So you're right. We started operations in the month of February with a clear focus that we would focus on customers from EWS and LIG. And Shriram, I think we must thank you and NHB team. Right from the first month of February till June, we have received the PMAY CLSS subsidy, and we have passed it on to the customer. Okay, so I think it has come. We are the latest, but I think it's been a great help to a new company like ours, because the challenges that we have. Promoter has put in his own equity, but in the morning we spoke about how much can equity do. You require leverage. How do we get funds? If funds come to us at a premium, then how do we make sure that the business proposition is such to the customer that it should not become expensive for the segment, because the segment is also rate sensitive. So I think it's been for us, team at Kush, I think it's been a huge experience, and it's been a very rewarding experience in terms of initially building the team, then, setting up centers. For almost 60% of Shriram, our business is PMAY CLSS. Okay, and the average ticket size is about 8.5, 9 lakhs. So, but I think, we have a request, that right now, Amit also mentioned in his speech today that see, companies that are focused on PMAY CLSS, if NHB team sits with us, understands that, we're looking at, for example, 100 crores of origination this year, and if our average is going to be about 60% CLSS, then can we be given a line of credit of, say, of that much amount, and, which is to be given over a period of time, basis our performance, which will be used only towards PMAY CLSS customers, because it's a huge challenge. We have reasonable equity, we have the bandwidth, we have the people, we have invested in systems, but having spoken to a number of bankers, across the spectrum, we are a new company, so we are not rated, so that's a typical challenge.
Okay.
So I think even instruments like mutual funds can invest into, if basis the capital, basis the overall business plan and the delivery, if banks can have a friendlier approach towards new housing finance companies.
Okay, I thought being a moderator, I asked the question. I have to answer some questions, but I will cover that. Coming back to you, from Aadhar, you have been there for some time. You have taken, I think your average ticket size is 8-9 lakhs.
7 lakhs.
So probably you are in a little bit of sweet spot compared to her or compared to him. What do you think are the funding challenges and the customer challenges?
Actually, what Milind has said, the funding challenges are different for different companies. HFCs, which are much bigger in size, for them there is no challenge, their parents are good and they are able to get, the rating is good. The funding challenges for us also do not come because we have also a good parentage and we are able to get funds. But as Mr. Milind was just mentioning, that resource mobilization for the new housing finance company which are set up, for them it is a big challenge because they cannot have capital market through NCD, their rating is not there. Yes. Banks do not give them loan, or they charge high rate of interest. If they charge high rate of interest, they have to pass it on to the ultimate borrower. So for them it is a challenge. Secondly, capital is also a challenge for them because NHB does permit 16 times leverage. But the banks or rating agencies are generally comfortable 10 to 11 times leverage only. In that situation, for them, it is a big challenge. I would like to suggest that NHB should consider of giving more of a refinance to the new housing finance company, which are primarily participating in housing for all to the PMOE projects and to the EWS and LIG. Because in that cases, the funding is done by them and that these housing finance company can do much better. Now coming to the another area where they can do resources they can get is securitization. The whole model for the small housing finance company or housing finance company has to work on originate, hold and sale. But as per RBI guidelines, you have to hold for at least 1 year. So it means for at least for 1 year, funding is required to be met either by the banks or by the NHB. As regard banks are concerned, they will always consider the rating agencies report, they will always consider the risk perception, everything they will consider. So my view is that here as a regulator, NHB has to come into the picture. They can raise resources through infrastructure bond, they can raise resources through ECB, they have got multiple powers to raise resources and they can provide some finance to the new housing finance company till they mature and they are able to get funds on their own. Coming to the another point in the lower ticket size, the borrower side. The borrower are also, suppose a guy who wants to take 5 lakhs rupees loan and is a rickshaw wala or sabji wala, if you expect them for contributing 10-20% of his own equity, is a challenge for him. Housing for all in the credit linked subsidy, I will just suggest, this is a very important suggestion which I want to give, which has been tried by the government of India in last 30 years. When the banks were providing loan to the various employment generating scheme, the subsidy given by the government was supposed to be taken the equity or margin of the borrower by the bankers. Why not in this case when 2.20 lakh interest subsidy is to be given for a loan of 6 lakhs and above? In that case, if the part of that equity, the lender like HFCs and we can treat as a borrower's contribution, probably the challenge which borrower face in the beginning to arrange the margin money will be solved. What happens sometime if you expect a rickshaw wala to bring 1.5 lakh rupees at 10% cash margin plus 5-6% more expenditure, if you expect him to bring 1.5 lakh rupees, he will borrow from somebody. If he borrows from somebody, he has to pay that money to that lender first. In that situation, the HFC's installments get defaulted. So my suggestion to the NHB, to Kalyanaraman Sahab, that if the borrower I select, if they approve he is qualifying for subsidy, we should be allowed to give 100% loan to him, and when subsidy will come, automatically LTV will be ensured. That was a valid suggestion which has been always tried in all government scheme, right from 71 through banking system. It can be tried here.
I will come back to you, Anil. Now, you have built up, you have bought over some portfolios. I think you have also done a securitization, no? No,
I have
okay.
not bought up a
Oh,
I haven't
okay.
bought it.
Okay, sorry. So what do you think? Because you operate in still higher segment at about 15 lakhs or 16 lakhs, and you have consistently been developing that.
True.
So I'm just trying to get the various sizes, because is the problems different across on funding, or is it?
I think when we look at home finance as an industry, it's like now 4-decade-old industry. So it has got talent, it has got processes, it has got technology. So all the three things are available as far as housing finance companies are concerned. Look at the leaders of the industry. SDFC is 4-decade-old and it is still growing at 22%. Look at the new one. So when I started 25 years back in the home finance industry, we were 4 home finance companies. Today we are Aspire was 62nd home finance company, again thanks to NHB, and today we have 77 home finance company, and it's still growing and going on to become 80 or 85 by end of this fiscal year. So what does it clearly indicate? That there is a pie for everyone to address in this market. So I probably would say that one of the important reasons to plug and control is the capital. Perhaps the 10 crore capital has an entry point for anyone to come into housing should be increased to a larger amount, because then some serious players would come into housing. So that could be one of the aspect of bringing in serious party to the housing industry now and participants. Once you have a larger capital, then you have a lot of confidence coming in from banks. When you go to borrow from them, the year one you could leverage or could get a gearing of 2 or 3 times. So on 100 crores of capital, you can do a gearing of 3 or 4 times, which will take your balance sheet to a 300-400 crores in the very first year of your operation. So clearly, the industry is growing. I guess when you put your technology, processes and systems in place, then companies can grow. I think from a regulatory perspective, 27 years of NHB, no systemic risk. It's a great salute to the regulator to have built a strong regulatory environment, to have built an environment within a real estate fraternity which was unregulated for so many years. So clearly, I think housing finance company vis-a-vis bank, housing finance company vis-a-vis the NBFCs have played the part. And my own belief is that is still going to play a very, very important part as we progress. I guess the entry point of housing finance companies should be little more tighter in terms of capital, because capital is something that will bring in the seriousness of the entire process. Whether it is liability machinery moving, unless you don't have the capital, you don't expect bank to fund you. Unless you don't have the capital, you don't expect the rating company to start rating you. So it's very, very important that you start bringing in the right amount of capital on table, so that the professionals who are participating can also participate. Interestingly, when we started Aspire, and today when Vivek, Mr. Oberoi was presenting Karam Builders, I realized sitting there as an audience that I went to Shahpur looking at this project, and when I looked at this project, we funded close to around 200-300 borrowers of Shahpur without knowing that Vivek Oberoi is anyway connected or to this project. We looked at those customers and we funded that. And I come back from and I take just a little more seconds to just share. When we look at three major players in the industry, SDFC, LIC, and for some time, let's take ICICI Home Finance in the erstwhile ICICI Bank status. All three of them grew each of the market in some of the market in the country. So when we look at SDFC, we all know that SDFC played a very important part when Navi Mumbai and Vashi was getting constructed. And what was Navi Mumbai and Vashi? What today I do as Aspire, what I do in Shapur was Navi Mumbai and Vashi probably 15 years back. That time SDFC participated. It was a quasi-legal document. It was a quasi-income document. But SDFC participated, and so did ICICI participated in extending Mumbai from Mira Road to whatever place. So did many other players in many part of the country. So anyway, in any given start, there has to be certain market, there has to be a niche that one creates, and one has to participate on those niche and build the systems and mechanism to control, because what is more important is what you lend, you are able to collect it back. And in housing finance company has proved it over decade, year after year, that their collection mechanism is much stronger. The collection mechanism is able to sustain the requirements of the industry, and in the worst case scenario also the HFCs overdue collections have never crossed 2%, minus few of the outliers in the industry. But clearly there is a lot of belief in the consumers of India. There is a lot of belief in the regulatory environment of India, and there is a lot of belief in the lending ecosystem that has got developed over last four decades. And I believe may not be very happy note for media to hear, because they don't want to hear all good things, but housing finance regulator and perhaps banking has played their part in a very good way to have built the ecosystem the way it looks like today.
Very good. I'm quite happy because this is the only person in the panel who hasn't made a demand on NHB. I will come back to you, Sandeep.
Yeah.
You have made probably a big transition from even selling your 40 lakhs or a 1 crore car to probably a 10 lakh house of funding, sorry, not selling. So one, what do you see as a change in the approach to the customer? And two, how do you underwrite these guys? Because the underwriting in this segment, and some other panel also discussed it in the morning, as how do you think is the best way to underwrite these people?
Shriram, I think it's a significant transition, not only for me, but for a lot of people in the industry, because with a 9% mortgage penetration and the sheer demand supply gap in affordable housing, it's a significant opportunity and a huge challenge, and it's great learning. And what you've got to recognize is, in this segment, you're not going to the top end of a mass affluent customer or an affluent customer who's got many choices, many options, and the customer is the king. Here you're going to a self-employed or a salaried tier 2, tier 3 Indian whom you're betting on to protect his first house where he's going to stay. And that is the critical difference. So you're betting on an Indian who's buying his first house, who's mostly self-employed. You're betting on his employability, his ability to take care of his family, to protect his interests and to protect his family's interests. And you'll rarely go wrong. And that's the reason this industry is a AAA industry. If you look at why, what I keep telling rating agencies or others, is that this is an industry which is AAA by nature. As Anil said, delinquencies have not crossed, or loss rates have not crossed 2%. And there's consistent systemic stability that's been demonstrated. That is by the sheer nature of the customer. And they work so hard and they're so committed and dedicated to making this happen. So if you can have underwriting capability to eliminate fraud, and fraud could be a variety of frauds. It could be a setup fraud, it could be a title document fraud, it could be frauds which are essentially perpetuated by small-time developers, or it could be organized frauds or identity theft. But if you can manage that, then downside risk on this business is very low. And that's the significant large opportunity. So if you can manage your costs well, which most HFCs do, if you can understand that you can get adequate banking system leverage to make sure that you can build scale, and you can service these customers and have continuous engagement in a community lending model with these customers, I think sky is the limit for this opportunity. It's a great business to be in.
Thanks, Sandeep. Well said. Vivek, I'll come to you. Probably the odd man out in this.
Yeah.
And
It's very important, sir.
Very important.
Insurance is very important.
But before I became a regulator, let me say, now my views have changed, of course. Before I became a regulator, I was not a great fan of insurance. I always thought the customers are taken for a
ride.
Not for a ride, but they don't know what they are getting into. Many of them have not been told you will get only a construction cost, so on and so forth. But things have changed, right? The focus has also changed to affordable housing, low-cost housing. The specter of the customers who are coming in through the door is different today. With that in mind, and from what you heard, how do you think the insurance will evolve? How do you make it affordable to the customer?
See, since morning we've been talking of affordable housing. Now let me come to affordable insurance. So insurance is really, really affordable. We need to educate the customer. We need to jointly educate the customer. The cost of insurance for a 10 lakh loan is less than 1 rupee a day. So for a affordable housing, if the loan is 5 lakh rupees, for a 10-year tenure, the cost is just 50 paise a day. So that's the cost of insurance for the loanee, for the customer. And with the catastrophic losses that we have seen in the past 3 years, the Uttarakhand floods, then Jammu and Kashmir floods, Chennai floods, and just a couple of weeks back, I got the photographs of Jodhpur. I was just discussing with Shruti. Jodhpur has been a dry place in Rajasthan, and they have, Jodhpur has witnessed the worst rainfall in 90 years. So we've been lending on a pan-India basis, but there are certain companies which are region specific. They concentrate on a particular state, in a particular state. So they need to take care of the risk as well. Plus, it's a revenue model for the HFC as well. They, with the kind of leverage and the kind of capital which is scarce in the industry, they can earn some kind of revenue as well from the insurance company. So if we talk of long-term benefits for the insurance company and the loanee, I think insurance is extremely, extremely important, and we need to jointly push for this. So I think this is an important aspect which it could be any company, the asset needs to be insured. So that's what the point is.
Shruti, you said in your discussions, you had a bigger problem on the title to the customer.
Correct.
Do you think insurance works in such a way? Because they are anyway giving you the construction cost, and your set of customers in all probability would be the most prone to a flood or those kind of things, because they might not be in the, most vulnerable to the floods, because they might not be in the best of the areas, purely on affordability basis. Do you think that would work?
See, I will answer it in two-phased manner. First and foremost, we are talking about property titles where they have a right to stay. So for example, even if I talk about those pattas or the lease deeds in Rajasthan and MP and other states, or if I talk about possession slips in Delhi, they merely have a right to stay. So for example, in a place called Jahangirpuri in Delhi, where they have been given those possession slips way back in 1972, it's just an occupancy right, and in the government record, the property has not been transferred in those individuals' name. So that is where the asset insurance companies will also have an issue, whether these kind of properties can be insured or not.
See, coming back to title insurance, the regulator, that is IRDA, has not allowed title insurance in the country as of now. So that's a major issue.
Worldwide, she's not talking on title insurance. She is saying where I do not have a title and where I am having a house where they are funded, will you just cover the cost of construction if the house gets damaged?
Absolutely, the cost of construction would be covered.
Right. So that is a good news. Now let me take 1 or 2 points before I go. One is, they said on refinance. Refinance is open for the last 6 months for all the new companies. I've been saying this in every seminar. We do not have the restriction of 3 years, right?
Yes.
However, subject, and she knows that, subject to some of the credit conditions which we have. Because as I said, if we have a good track record, I don't want to be the MD who broke the track record, right? And probably as the in various, this one we are told this is the only industry which probably is holding out today on the bad debts. And it is all of our responsibility to keep it that way. Second is securitization. We had worked with the government, and in the recent budget they've announced it. All the double taxation or the withholding taxation has completely moved away. Now to go and tell Reserve Bank don't create a holding period has a lot of macro implications. It was done with specific studying of various models. I've seen that. So even I wouldn't be sort of taking it up immediately. You book a loan and onward passing, and we all know what happened in US on the mortgages precisely by doing these kind of things. True. There was something mentioned on equity. What was that you mentioned, is it?
Yeah, I mentioned.
What is
The
that?
borrower, when we give him loan, 10% he is required to bring,
Yeah.
5-6%
Margin
expenditure he
But
does.
I'm saying a rickshawala is not going to 10 lakhs. A rickshawala is going to take 2 lakhs, and we expect him to pay 15,000 rupees. Now, and that will get passed on. The problem is, world over it has been proven that where the customer do not have some equity, then those loans go bad. This is not India's expertise. And when we say the overall delinquency is 1.5%, it is a little like trying to cross the river by its average depth, right? You all know what would happen. When I do a cut of below 2 lakhs, we have a overall delinquency of about, and I'm talking only about HFCs, it's much higher for the public sector banks, 6%. When I take the cut to 5 lakhs, it's 2.5%. At 2.5%, you have almost lost the profit margins, right? And then it improves up to 10 lakhs, it becomes 0.92, 0.48, and so on. However, this is historical. Let me also say, when we do this, the new underwriting, as we see the data, does not seem to be purely because of two things. One, evolving of credit bureaus. Two, underwriting techniques have improved. People have not blindly underwrote. I know companies which use credit bureau characteristics to build profile and take decisionings.
Yes.
I know people who stand outside the small shop and see, actually put their person for 1 or 2 days and see what is the income, what is being sold, so on and so forth.
Corroborative.
So to that extent, it is completely evolving, and we need to watch that out. While we are willing to support, we need to watch that out.
In fact,
Title insurance, let me complete.
Yeah,
Title insurance, we have set up a working group with IRDA leading it, because it's rightfully they should lead it. We are examining all the aspects, because if we cut and paste what is being done abroad, it doesn't solve our problem. And we have a genuine problem with various state governments having different laws, title, whether it flows or not flows. So it's going to be complicated, but a decision has been made. We said we will attempt, we will start with the easier things to fix first, and then move on to the complicated things there. Hopefully in about 6 months or 8 months, we should see something evolving there, especially towards the low cost housing.
just
Right.
had a point. In the last 6 months' experience, I think what is also coming across very, very clearly is service delivery is a key differentiator. You know, I think the customers coming from EWS and LIG customers, I think they also have to be given the same kind of respect and service by all of us, the entire industry, you know, which you would give it to a, say, a private bank customer. Okay, so that's been a learning for us. We have actually we have a standard where when, you know, we actually ask the customer to inaugurate our branch. We are, you know, we ensure that the customer's disbursal is a pleasant you know, kind of a occasion for the customer and the family. Also, in terms of credit behavior, I think what's also very, very encouraging is almost 35 to 40% of customers have some credit track record, bureau scores. In fact, for us, where we almost 60% of the business is PMAY CLSS, the average CIBIL that we're getting is about 725 to 750. You know, a lot of these customers have availed you know, two-wheeler loans, fridge loan, or TV loan, you know, or a lot of these customers also have, you know, SIPs going, they have insurance going. So as an organization, we are trying to evolve, you know, a scoring pattern ourselves, where, you know, basis the savings of a customer or his family, or the track record in terms of repayment, we are trying to arrive at, you know, his future repayment with us. So I think it's quite good.
which is good. I'm only saying bureaus have also evolved. What I'm told is a no-hit score. Even if there is no credit history for the customer, they are still able to create a score, test it out.
Okay.
Now I come back to your question, how do you do your collections? Because in your way of operations, Anil, collection is very important, and if an EMI gets a little, let's say, added, then it becomes impossible to do it. So collection management has to be that
Very
tightrope
stringent.
walking where you reach him on time and the right amount of pressure is put. What are the challenges and how we have overcome that?
Very important. I think when we look at parameterized lending versus non-parameterized lending, in parameterized lending on a typical collection efficiency, which is the date on which a consumer has to pay his EMI, one typically sees a collection efficiency of somewhere between 96 to 98%, which is the receivable on a particular date you get received monthly to the extent of 96 to 98%, and the balance amount has to be then through phone banking or through collection mechanism, they collect it before the end of the month and they have a 0.9 or a 1% default as they continue. In a non-parameterized lending, companies like ours and some of us sitting here, we normally see that on a collection day, we get an efficiency of 88 to 92%. It could even go worse during festival month, even it could go worse during school admission periods when the collection efficiency go as low as 85% on the date of collection, which is if your collection day is on 10th of every month, on that 10th of day on a receivable that you're expecting, you would only get 88 to 90% consumer paying it on time, and balance of the 10 to 12 customer you need to have a collection mechanism of ensuring that you remind them and you ensure that they get collected before the end of the month. So unless you have that mechanism in complete, you obviously would have troubles of installment getting into the bracket 2 or bucket 2, and to maintain and for the consumer to pay that bucket 1 plus bucket 2 is next to impossible. He will maintain that one installment as an arithmetical default for overdue default for as long as he gets a good crop or get some amount of in-laws money or somewhere where he gets money, and then he pays that one installment. So my whole concept is that till on the date of collection, you would have to be very sure that you reach out the customer on the very day, informing him that you have to make the payment of your installment before the 30th of the month. And you probably through education process, you ensure that your 88% or 85% collection efficiency improves to 90. But we have seen in the informal sector, which is neither see in a lender, as a lender, we no one want to be a lender of last resort. We don't want to be lending to someone who is not going to repay us back. We always want to lend to someone who is going to repay us back. But we also know that we can't be a prime lending customer, because those customers would be asking for a finer rates, and as a new company, we can't afford to give them a finer rates, which means that we have to be a mid-prime customer. We have to choose a methodology of ensuring that our DNA, our ecosystem is built in such a way that we service the mid-prime customer and we build the ecosystem to service those customers. And hence, Shriram, collection is very, very critical, and especially between 10th or whatever your day of collection to the month end, your collection mechanism has to be very, very important. One of the ways that industry has looked at collection is the originator is the one who collects it. So maybe that method has worked well. The lender collects it. Whoever is lending are the one who are collecting it, and they don't build a vertical called collection. To collect, they do the collection. That has worked well with many of the organizations. There are organizations which has disincentivized or at the incentive level have kept away certain incentive for the health of the installment for 12 months. Unless the health of the installment is not proper, you don't pay the complete incentive to the front end team. So there are many methods of managing it, but yes, collection is very, very critical. My own personal belief is not the consumer who default, is the system that makes the consumer default. And if the system is good enough, then consumers do not prefer to default in a house in which he or she has put in a 30-35% equity, and it's a dream home for them, and they want to have that house has a productivity enhancer for them, and hence they don't want to default. The emotions attached with that house is very, very, very high. So my own view is that it's the system of the housing finance company, and it is very strongly reflected in HFC versus bank, because that is one parameter where we score very high on the collection side. HFCs have a very good mechanism of collection, and we believe that that's what is keeping us going.
Right. Anil, that is crucial. One, the equity, and two, the emotional attachment. In fact, I was handling mortgages for a large bank when the Hong Kong crisis happened. And when we went and studied it, one of the biggest things they said was, the crisis happened because the government removed, by way of an act, the social stigma of filing for a bankruptcy. The moment you removed it, the Hong Kong property values were very high, everybody thought that is the best way to go. So as far as there is a emotional attachment and a social pressure, it holds. Shruti, would you like to say on that, because your segment is a little more different, little more pressurized? Do you do weekly collections, or how do you go about it?
No, we have moved away from the typical microfinance way of collecting loans. Weekly, I don't think they will be able to serve us in that manner, because typically this segment does borrow from microfinance institution, though they have at least 3 to 4 loans going. However, we may want to put it that we do not want to encourage over indebtedness, but they do borrow, and small amount of loans is what keeps them going for their consumption needs, their income generation needs. When it comes to housing finance, our experience has been that they are aware of the EMI pattern. They know that for housing finance and for any kind of credit for home improvement, there is a pattern or there is a methodology called EMI, and therefore that is what they would also want to follow, because this is typically a large amount of money, which if we collect weekly from them, it will add on to our cost. We cannot do that. We cannot have PDCs going. We typically want to discourage any kind of cash collection. So what we essentially do is the monthly EMI collection. One thing I would like to mention on the underwriting and the collection side, though community lending or self-help groups is not possible in a housing finance format, within a household, any adult who is able to contribute to the household income should be the co-borrower. So that is something which we encourage. We even in the corroborative evidences that we collect for our income assessment, like going to their place of vending or calculating their cash flow for their kirana shops or their garment shops, we encourage that all the household members, earning members should be there, part of the discussion, and the lady who is our prime borrower, who is our first borrower, should be made aware of what are the problems which will crop up if there is any default. So that kind of education should happen, and this whole within the family there has to be, I call it within family there is a JLG which is formed, and which acts as a kind of a incentive, and it kinds of encourages them to repay on time.
Right. Just one, this one, I don't know whether you have tried. Now the government has moved toward DBT, direct benefit transfers, and invariably it happens on fixed days, 2 days in a month. Would you like to put your EMI on the same date a standing order from the bank accounts? Will that benefit? Because customers on your profile, if they withdraw, they might spend.
Yeah, that's
just a food for thought.
Yes,
we used to do it in the personal loan days. The EMI date will be exactly the salary credit days.
Yes.
So we do that. We during our course of loan evaluation, we do collect that data and accordingly fix up their EMI dates. But on the DBT date, the system is yet to settle down. There are so many cases where the entitlement is given to somebody else and it is due to somebody else. So let the system settle down and then we can certainly think.
Direct to you, now if there are so many, is there insurance companies, will they think of a credit default insurance, for example, as a group, if not as an individual?
Not at the moment, but there's a price for everything. So we'll have to go to the regulator and we'll check up on that.
Right. But having said it, what NHB has now done with HOOPA, and morning secretary spoke about it, it used to be 3 lakhs, the government's credit guarantee fund. Now it has been moved to 13 lakhs or 15 lakhs of the loan amount, and credit guarantee will cover up to 8 lakhs. And it's a standard pricing. Government doesn't price it for risk. It's 1%. You could always cover it, right? In fact, every time I'm being questioned why people are not using it fully or not claiming from it, and I always stand up and say it's like regretting that you are not claiming your life insurance, right? It's a little like that. You are happy that you need not claim your life insurance. So, but I think it is being not used enough by especially the small ticket players, to charging that 1% to the customer is not going to mind. I'm again and again saying that 1% or 2% more on an interest rate in this segment, while it might not be politically correct to say, might not matter to the customer, because his other alternative is go to an unorganized sector which is much more higher and with the not so desirable consequences. So that's why we even went to RBI and we got permission for you to charge more, 3% from the existing, or 3.5% on the rural housing fund and urban housing fund, which you guys could use it, because we said anything from an organized sector is much better for the customer. So use the credit guarantee product much better, because now it is there. 2, even at higher levels, the IMGC, the company where we had invested, would take over, but that's market pricing. Again, I'm saying even at that level, the informal customers might not mind paying 1.5%, 2% as a one-time fee to get it running. Any other points?
I
will just add.
have a point on IMGC.
Please.
See, the way I see this is, it has to evolve to products that typically will work.
I will.
The challenge here is very simple. If all products that is acceptable to the core banking system, what the banks are doing, the credit risk the banks are taking, if that's the kind of risk that IMGC is willing to underwrite, I don't need them, my capital is good enough to underwrite that. What I want is, if you go down the supply chain of customers and the value chain, and we are taking incremental risk. So a part of that incremental risk is what we would look at IMGC to cover in a structured, cost-effective manner, and those are customers who, as you rightly said, are willing to pay that 150 basis points extra.
Okay. So
you can price it.
Sorry, you are saying, Sandeep, it cannot be priced very high, but has to be priced reasonably as a risk share.
Yeah.
Okay.
Sir, I think what you have mentioned about Credit Guarantee Fund Trust for Low Income Housing, it is the most important organization which none of us are using that aggressively, where 1% or 0.05% is the guarantee fees, one time only, and they cover up to 8 lakhs rupees. The only one rider is coming in this, in low income, in the housing for all, where you are doing under PMAY, the credit guarantee scheme says these loans are not covered because government is extending them interest subsidy. My only submission, interest subsidy is for demand side, it is for the borrower to get its more affordability for repayment of loan and more loan. And credit guarantee fund trust guarantee is for the lender, for the housing finance company. Therefore, if you pitch with the government and tell them that credit guarantee fund trust scheme should be extended for all loans up to 8 lakhs rupees, which is presently available, irrespective whether they are falling under PMOI or they are done without PMOI, that will be more incentivization to all housing finance lender. It is better than IMGC.
We have discussed this enough times. There is one point here. CLSS, we are looking at the way it is taking over. Morning I said we have done about 143 crores, which is probably much, much higher than any other schemes. We look at doubling or tripling it in the current year. The problem is, same customer gets an subsidy, same customer defaults, the entire benefit starts getting into the same customer. The worry with the government, and rightfully so, it cannot get an organized way of thinking, which could happen considering some of the schemes which are earlier gone. So it's very imperative we learn, we have data inputs, we give it mature, we analyze it and then take this call. But sir, having said it, we have discussed with the government 3-4 times, and it's been a very considered decision that at this point in time, we won't cover that. Just a question before we close. Will having a standard buyer's agreement pan-India vendor, PMA may give comfort to lower middle class to be sure with the documents? Ashish Gulati, you want to answer that? Is it even possible to get a standard buyer agreement across the country?
I think it can be made, sir. It can be made. Only
why
if
should you
the
have a
government
standard- why should
initiates
you have a
through all
standard
state
one?
government can be made.
But why do you want a standard one? The
Implications.
the culture of housing is very geographically defined, so people
It's
have
like
to
30
see and
different
feel.
countries.
Yeah.
We have 30 different countries, so 30 different thing has to be there. What people understand, they have to give them what they understand.
See, having done it, we worked, the urban housing and urban ministry has worked on a standard develop a standard agreement which will be put as a model agreement. Now, whether states mandate it in a federal structure is left to the state governments. For the PMAY, we have worked with IBA and HFCs and suggested again a standard format of documents and application form. I do not have data how many of them have adopted it. But again, it is individual. If one company comes and says, I cannot adopt it, I need these two clauses in my agreement which is going to protect me, then I cannot come and say, no, you need to adopt it, because it depends on the risk appetite, on the interpretation of that company, of the local law, and what do they need.
Correct.
That is where it comes in. So it's a good suggestion, but at this moment, I would say it's a little bit theoretical. Let's see when the real estate law comes into force in all the states, how many of them adopt, how many of them take the standard agreement, then probably in majority of the states, at least in metros, it could come true. Any other comments from the panelists? Not, okay. I thank all the panelists and the audience. Thank you, unless you have any other questions.
Thank you so very much, sir. And sir, may I request you to please present a prize to the one who raised the question, put it online with our hashtag. May I request Mr. Gulati to please step forward? Mr. Gulati raised a question, but he's not here to know the answer.
Probably is watching through live.
Yes, probably. Thank you so very much. Let's put our hands together yet again for our panel chair and our panelists. And may I request Mr. Kapoor to please step forward and thank each one of our panelists with a token of our appreciation. Post this, we'll meet for networking tea and coffee, so you're more than welcome to raise questions offline or share comments, whatever you prefer. Once again, a reminder to all of you to please fill in your feedback in our feedback form. This will just help us know better about what you felt of the first edition of our summit. And once again, I'd like to take this opportunity to thank all our partners, our title partner, Khush Housing Finance. I'd also like to thank our knowledge partner, National Housing Bank, our associate partners, Experian. Of course, thank you to LIC Housing Finance. We'd also like to thank Aditya Birla Housing Finance, HDFC, India Bulls Housing Finance, and Shriram General Insurance. Once again, a big thank you to our audience. If it wasn't for you, we wouldn't have been able to put all of this together. So thank you once again for joining us.